Hello traders, and welcome to this presentation about trading the opening range or defining range, also known as the initial balance. I have a lot of great information to share with you today. If you trade index futures like S&P and NASDAQ, I think this is going to be very helpful. We're going to go very in depth and look at a ton of examples on how you can trade the opening range. You may have seen my previous videos regarding the opening range with respect to the DR with ICT concepts. If not, I'll leave links in the description below. But essentially with those videos, I was talking about trading models that could be applied after the 9:30 to 10:30 time period. So once that range has formed. But oftentimes many of those setups don't show up until the afternoon session or even during the lunch hour. And there are just so many great moves that happen in that first hour of trading that I really wanted to make a video to discuss it. So first, a quick disclaimer, this is not financial advice. Everything discussed in this presentation is for entertainment purposes only. Very quick intro to what the opening range is. As I just said, it is the time between 9:30 and 10:30 a.m. New York time. So why is the opening range important? Well, for me, it's important because the high or low of the day is usually formed during this 1 hour period. Not only that, the market often produces very dynamic moves and price swings during this time, also known as the AM trend. I want to make clear that the information presented here is not my original idea. The credit has to go to ICT, the Inner Circle Trader, and his month 10 core content where he talks about the opening range. And of course, the 2022 YouTube mentorship. If you haven't seen it, you really need to before watching this video, because in a nutshell, all of the trades that I'm going to be talking about are essentially liquidity grab setups that he teaches in that YouTube mentorship. So please check that out if you haven't already. And lastly, I want to give respect to a trader named Phantom ICT. You should consider following him on Twitter. I don't know him. I'm not affiliated with him in any way, but I do like to hear what he has to say. He posts a lot of great content. And before his tweets, I basically traded essentially very similar setups to what he has been tweeting about. It's like I said, these liquidity grab setups taught by ICT, but I never before really differentiated them into separate categories the way he has. And in doing so, it's allowed me to narrow my focus even more and be more dialed into the opportunities that appear on a regular basis. I can go through a sequence of if this, then that, and make my decisions much quicker on what I want to do that day. So I'm going to summarize those categories that he shared, but I'm going to also add my own perspective and point out things that I do differently. There's quite a bit of things that I do differently. Not that there's a right or a wrong, but I'm going to just go into some of that. And so on the agenda today, we are going to look at the key times of day to focus on here. We're going to look at the 3 types of liquidity grab setups, which ticker to trade, because we're going to be looking at S&P and NASDAQ and sometimes the Dow, and you will have to make a decision on which one do you want to trade. And then throughout the video, we'll be taking a look at the higher time frame. Is that something we really need to incorporate into this? I believe it is, and I will get into why in a little bit. And then lastly, SMT confusion. At the end of the presentation, I'm going to go over to some examples on how things might be a little confusing sometimes. Not everything is picture perfect clear all the time, and I'll have some ideas and suggestions to work through that. And also, I just want to make clear, I am not a formal educator. I am just a guy on YouTube. I can't promise that any of this stuff that works for me is going to work for you the same way, but I do encourage you to do your own study, and I'm sure you will find what resonates and what works best for you. Hopefully, this will at least be a starting point and give you things to test and consider and analyze for yourself. Okay, so first, the key times very quickly. Before 9:30 a.m., that's our pre-market or overnight session. And then at 9:30 a.m., that's when the New York Stock Exchange Open is, and that's when volatility often enters the market. We will only execute after 9:30. At 10 a.m., that is a possible reversal point or turning point. It can be useful for sometimes entries, sometimes exits, depending on the context. And then at 10:30 a.m., that's when the opening range has formed. We look to take profits or potentially close our trades, or we might want to trail our stop or do something to protect ourselves, as the market may see a retracement or a reversal from that point. Like I said, you might want to do that at 10 a.m. depending on the context, but we'll look into some examples later so you can see what I mean. And then 12 p.m., that's when the lunch hour starts. And on days with large price expansion where you have a clean bias, very clear bias in one direction, the trend can continue up until this time. So again, there are some variances. It's not always one way to play it. I'm just giving you a kind of a bigger picture view, and then you can design your plan the way you want. If you want to be done at 10 or done at 10:30 or done at 2R, 3R, whenever some target's been hit, you can create your own customizations to this. So moving on, the three types. What are the three types? Well, they're all basically the same thing. So I don't want to get too caught up in very different things. Like I said, this is all stuff that's already been taught by ICT essentially, but it's just broken down into a couple different categories. Number one, type one. Again, Phantom ICT talks about them as scenarios, but because I already have a video series about scenarios that relate to something entirely differently, I'm going to just call them types. And so type one is the pre-market liquidity grab. So there's 5 steps. The first thing we want to see is the liquidity grab before 9:30 a.m. And you can see here on S&P, price has a low right here, which we can mark out and see that price makes a lower low. At the same time, that step 2, we see a divergence. We can look at NASDAQ and see that NASDAQ makes a higher low at the exact same time. So step 1 is the liquidity grab. Step 2 is the divergence. Step 3, we have our displacement, basically an impulse leg. It's an energetic move. In this case, we want to see it go above a short-term high, and we want to see some sort of imbalance or fair value gap in its wake in this price leg right here. And the same thing on both charts. Basically, we want to see that displacement on both charts. We want to see take out some sort of high ideally, and we want it to leave imbalances. Step 4 is when we look for our entry. So now we are after 9:30, after the New York Stock Exchange open, at which point we are looking and ready and waiting for some sort of a retracement where we can hopefully enter a buy trade in this example. And so we might mark out this level right here. This is like a breaker here, or here maybe you want to enter on NASDAQ and there's an order block or fair value gap here you want to enter, or maybe you want to draw a fib from low to high and buy at the 50% or the 62 or the 70 or whatever, or maybe there's some other confluence or higher time frame level you want to bring in, or something that you like to use to give you confidence to say, I'm going to buy at this level or this level. And I'll give you some ideas later of what you can do. But you're going to have to decide for yourself exactly where and when you want to enter. This is the basic picture of what we're looking for. And finally, step 5 is our target. We expect, now this is not always the case at 10:30, but it's just sort of the general thought process is that by 10:30, we would like to see our liquidity target, in this case, this buy side liquidity target here, we would like to see it hit by 10:30 a.m. or potentially close the trade. I should have put an asterisk right here. It's not always the case. Maybe you, on one of these days, if you're looking at the higher time frame and you think there's good reason for price to continue, you might maybe want to take a partial. Maybe you want to move up your stop so you're protected and then just see what happens the rest of the day. Maybe you want to go for that 12 p.m. noon target instead, or maybe you do, or maybe you have a predefined, I'm only going to trade for 3R. And once I hit 3R, I'm more than happy to be out of it and not look at the markets for the rest of the day. That could be what you do. There's really no right or wrong. And there's going to be situations where at 10:30, it hits and reverses. At 10 a.m., it hits and reverses. Other days where it just never reverses. It just keeps continuing. So it's just figuring out, what works for your testing, your back testing. So the question that's definitely going to come up is which ticker should you trade? As I said, I'm going to get into that in a second, but essentially it's, do you take the ticker that grabbed liquidity? In other words, do you take the weaker or the stronger one? Meaning S&P, we've made a lower low. So you might say comparatively from these points here, this is the weaker one because this one is stronger. It made a higher low. So you might say, oh, this is the stronger one and we're buying. So I want to be buying the stronger one. Others might say, well, no, this is the one that grabbed liquidity. And so this low is going to be protected. And it's going to be, therefore, this is the one you're going to want to trade. And actually, I incorporate this to some degree, but there's actually some other factors that I bring into it to help me decide which one I want to trade. So I'll get into that later on. So first example of a type 1 is right here. Now, why is this a type 1? Well, we have our step 1 liquidity grab, S&P making a lower low here, taking out this liquidity. At the same time, step 2, we have a higher low put in on NASDAQ. So we have our divergence. And then step 3, we want to see this displacement, which we can see right here, this big leg in price on both tickers. We can see the displacement leaving fair value gaps behind, taking out short-term highs. Let's zoom in a little bit because now we want to look at what we might do for an entry. So step 4, We might draw a fib from low to high. We can see that, hey, we want to buy in a discount. And that's what we're hoping to see when the market opens at 9:30. We want price to come down and hit one of our levels. Maybe it's the fib level, maybe it's a fair value gap or an order block. And then at 9:30, we can see, here we go, we get tagged in hypothetically, or maybe you want to see this first candle close, see it be respected, and then enter afterwards. And then you see what happens after that. Price skyrockets for the rest of the day. It goes completely off the screen. And this was one of those days where price didn't see any type of retracement afterwards. So clearly in this example, the first point I want to make in showing the sort of perfect example first, so there's going to be many examples that are not as clean as this. But the first point I just want to make is that sometimes it won't matter which ticker you take, as they both will work or not work. So clearly, if you were struggling to decide which one do you trade, S&P or NASDAQ, there's going to be a lot of examples where, the market is just determined to go in a certain direction, and all of them are kind of in agreement and moving very similarly, and it doesn't really matter clearly which one you would have taken. So let's look at another example. Let's look here. Sorry about the formatting on this one. I kind of messed that up. But here we have step one, our liquidity grab, also on S&P. And we can see at the exact same time, NASDAQ is making a higher low. So it's failing to make a lower low the way that S&P is. So first two steps are met. Step three, you can see that we have our displacement leg right here. Why is it displacement? It's an energetic move that takes out these highs, that leaves imbalance in its wake. And all of that is happening before the 9:30 open. Now we can see after the open that S&P shoots down to our discount area, to this fair value gap right here, and shows a nice reaction to it so far. Whereas at the exact same time, NASDAQ is so strong, so much stronger than S&P, it doesn't come anywhere near this corresponding fair value gap. And this is an example where if you were to take the stronger of the two, in this case in a buy scenario, if you were thinking, I only want to take the stronger of the two, you might see that something like this might happen, where you don't get your entry because it's so strong, it doesn't make its way down there. And you can see what happens afterwards. Both of them continue, and only one of them would have triggered you into the trade. And you can see it keeps going on this day all the way till about noon. It hits its previous day's high here on NASDAQ, this buy-side liquidity right before noon. And so the point here on this example is to show that sometimes choosing the stronger one, quote unquote, in a buy setup might mean not getting an entry. As I showed you here, that you don't get an entry, at least not down here. Maybe there's some other entry that you can find, but that's just something you have to be aware of. So let's look at another example. Here we have on December 5th, we have our type 1 again before 9:30. We have our liquidity grab right here on the right side of the chart on NASDAQ. Price is making a higher high. And on the left, price is making a lower high with S&P. And it's very, very distinct. It's very, very sharply different. It doesn't come anywhere close to this high. And these are the same times we're using here. And then after which point we see our displacement. We have our imbalance through our short-term low here on both charts. And we may say, this is great. I'm going to set a fib from high to low, and I'm going to look to short somewhere around maybe the 62 or the 70 or this order block, or that you might see that there's some imbalance right here. And so in this example, you're trying to decide which one should you take. Should you take S&P? Should you take NASDAQ? What do you think you should take? Just before I even show you, what do you think you should take? The stronger one, quote unquote, or the weaker one? We're looking to short. Well, in this case, the weaker one, S&P, reacts perfectly to our optimal trade entry area and sells off very sharply. And NASDAQ, as you can see, makes another run above this short-term high before continuing lower. So it does another liquidity grab right here. It's just to show you that sometimes if you take the one that has the liquidity grab before 9:30, you might see that actually it's so strong that it goes through maybe your entry or to your stop and does another run, another higher high basically between these highs right here. And the weaker one goes right to your entry and then straight to target. That's just something to consider. So in this example, the point is sometimes choosing the stronger one in a sell setup will mean getting stopped out. So that's just something to be aware of there. I'm going to show you now a way to maybe make a selection that's not determined based on which one's stronger, which one's weaker, which one had the liquidity grab or not. You can see we have our pre-market liquidity grab on NASDAQ. I'm also showing Dow. You can see it there too, at the same time that S&P makes a higher low. So that's step 2. We have our divergence after the liquidity grab. Step 3, we have our displacement. You can see we're taking out these short-term highs. So which one do we take? Well, in this example, between S&P and NASDAQ, both of them would have worked. So it wouldn't have mattered really which one you took. But I'm going to suggest another way that I like to decide which one to take. I like to see higher time frame levels in alignment with the lower time frame setup where possible. So if we look back at this example, and this might take some time and experience with ICT, understanding which higher time frame levels to look at. But in this case, here we have on the weekly chart, we have this red level right here. This is one volume imbalance level here. So we have this volume imbalance between this close and this open on the weekly chart. So for the sake of just having a clean level, I have just the discount level of this volume imbalance at the 39.6575 level. And I just have it extended out in time. And you can see that when I go back to the lower time frame, that volume imbalance level is in perfect alignment with this consolidation before the displacement up. If I look at NASDAQ, the only higher time frame level I was able to find that seemed valid was this old previous day's high that price was coming down to retest. And so in both cases, price is coming down. It had been trading above these key levels, and S&P came down to consolidate around this higher time frame level. And NASDAQ, just missed it. And so again, on this trade, you can see it didn't really matter which one you took. But for me, I would say, okay, I have our higher time frame level and we have our lower time frame setup in perfect harmony. That's the one I'm going to take. And as you can see on our retest and our entry on our step 4, in this example, price comes down, perfect tap to that volume imbalance. I'm not saying that's always going to happen, but I just thought that was pretty cool to see. And that's just something that I in general have always subscribed to in my trading, is how can I overlay a higher time frame reason to buy, let's say, with a lower time frame reason at the same price level at the same time. On that note of higher time frames, I like to use the higher time frames just to form bias for the day, just in general. This is a very corny analogy, but for me, the higher time frame is like a map of where the market may want to go. And the lower time frame liquidity grabs and entry models are almost like traffic lights and the actual cars on the road, where you can see the flow of saying, hey, which way are things actually moving? What's a signal for speeding up on the road? What's a signal for stopping and being more cautious? So for both of them, I like to use them together. To me, it makes a lot of sense. If I even jump back a few examples ago, where we have our displacement and our pre-market liquidity grab, our type 1. I would first, before even entering, I would say, okay, this looks like we're setting up for a really nice type 1. It looks like we're getting green lights to go down. Now, if I go to the 1 hour chart, now this is before the market opened, the same exact time, basically, I can see that we've had this very sharp, inefficient run up a couple days earlier. Price then went sideways a little bit, tried to go higher, got rejected, went down, started consolidating again. Bit of a displacement the previous day before, have these double wicks, which might be like magnets to price. We have a little bit of a rally back up, take out these short-term highs, consolidate again, and now we're breaking down again before New York open. So not only do I have this previous day's low that seems like market is starting to break lower towards, but we also have this inefficiency, this imbalance below that level. So now I have a couple reasons why price might be drawn here. Similarly on NASDAQ, they both look the same. And so how that day played out was like this. S&P hit that liquidity target, NASDAQ didn't. But clearly, even if it doesn't hit your target, I'm seeing the map that we're likely to go south on the higher time frame, and I'm getting the green light on the lower time frame. So that's just generally my thoughts on higher time frame. Next example, 15-minute chart here. The reason why I'm using that because it's a little bit cleaner. You can see this breaker right here. So we have this breaker and mitigation, and we have our imbalance on our displacement leg here. So we have our first 3 steps met. Now looking at the 5-minute, this is how it played out. You can see on the 5-minute, price rallied after the open on S&P, hit that mitigation block on S&P. Obviously, NASDAQ had been in that breaker and just sold off. And now the key point with this example, so look at this candle close at 10 a.m. Look at the price movement after 9:30 to 10 a.m. It's very choppy. It's not very energetic. even though we had this as a displacement that we saw kind of on the 15-minute, this is not really strong from here. And so notice now we're at 10 a.m. You can see at 10 a.m. we had high impact news on this particular day, consumer sentiment, and we can see that we got that reversal back up. So just notice the differences here. So this is the point of this, is just to point out again, as I mentioned earlier, that 10 a.m. can be a key time for a turning point. So what else can we incorporate to help us decide whether we want to be in this trade after 10 a.m. or not? So if I look at the daily chart, you can see on this day, just looking at NASDAQ, just to be clean here, you can see that we had our open at New York Stock Exchange open right here, this level, and we had that move down right into this blue line, which is this bullish order block on the daily chart. So if you didn't know before, now you know that 10 a.m. can be a potential turning point. And when we see just contextually that we are hitting this brick wall right here, potentially, of this daily order block on the map, combined with the price action that we're seeing on the lower time frame, we're stalling, we're heading into some congestion, and we have this news, we have this potential reversal here. If you haven't taken partials, then, if you don't want to close the trade, you might want to just protect your stop at least, just to consider that. You're never going to know for sure. You're never going to be able to see the future. So you just have to kind of manage the risk accordingly. Next example, here we have another type 1. So by now you know exactly what a type 1 is, I should hope. But clearly here, I just want to point out we have our lower low liquidity grab on S&P. At the same time, NASDAQ's technically making a higher low, but it really just kind of looks like equal lows. And we all know what is likely to happen when we see equal lows. We have our displacement, we have our fair value gaps below the market price right now. And then at 9:30, what do we see? Well, we see that an S&P reacts beautifully off of this fair value gap. If we had a 2R, maybe 3R target, we would have gotten our target hit within a couple of 5-minute candles. Meanwhile, if we had taken NASDAQ, we would have been likely stopped out. But just something to point out, that when you have very clean equal lows, maybe you don't want to trade that particular one. Looking ahead at 10 a.m., let's say you're in S&P. Let's say you picked the right one in this case, and maybe you took a partial at 2R, but you're still in the trade. But now you see it's 10 a.m. Do I want to stay in? Do I want to trail my stop? What do I want to do? You can look and quickly see this is looking very choppy. We've been very volatile, just up and down, up and down. We haven't really expanded and gone on a big trend like we have on some of the other examples I've shown you. And NASDAQ's also kind of very weak. It's very heavy comparatively. Maybe you now want to look at the higher time frame, as I hopefully have made the point clear that it can be very helpful. Now on the 1 hour, you can see a very clean order block. And let me just be clear. I'm not saying look at the higher time frame so that you can say, okay, this is where price is going to go next week. I'm making some big forecast to know what's going to happen. It's just looking at the higher time frame to help clear the picture, to help give you a clear picture of what might happen. We're operating on, a few hourly candles here, max. We're trading this opening range. We're not trying to see what the whole day is going to do necessarily, but we can see that we have this order block, this imbalance, this impulse move here on the hourly chart. And this is where we are at 10 a.m. We've already hit it. We've already tapped into it. We know 10 a.m. can give us that turnaround. And here you can see that price gives out and makes a lower low. So a couple reasons why we might say, you know what, I think we're heading into some congestion here. I don't want to be, holding for much longer than 10 a.m. on this particular day. And so now let's go into type 2. Type 2 is very, very similar, but it's going to all happen after 9:30. So this is the New York Stock Exchange open liquidity grab. Very similar, has some slight variations, but basically we have our liquidity grab happening after 9:30. So in S&P, we have these equal lows, let's say, before 9:30. Then at 9:30, the market opens and heads lower aggressively to take out these lows. Looking at NASDAQ, this is where we get our divergence. One might be making a higher low while the other makes the liquidity grab. Another key difference between type 2 and type 1 is that step 3, we're not going to wait for this whole displacement to happen on this time frame of the liquidity grab, okay? What we're going to do is we're going to look at a lower time frame inside this area and see if we get an entry model. This can be a short-term high being taken out on the 1 minute with a displacement. This can mean an order block, breaker, some sort of entry model that you are comfortable with. And then step 5, after we get our entry on our entry model. Step 5, again, similarly to before, it's a liquidity target by 10:10, 10:30, maybe noon, depending on the situation. So let's look at one example right here. This should be very familiar. This is basically what ICT has taught on day 1 of his YouTube mentorship. You can see here we have the market opening at 9:30, at which point price on S&P and NASDAQ shoot down, take out the sell side liquidity right here, also fills in this fair value gap. At the same time, on the Dow, we can see that the Dow is much stronger and has not made a lower low. It's made a higher low. So we have our divergence. Let's just take a quick peek at what the higher time frame is doing to see, do we really want to be buying right here? Clearly here you can see on the higher time frame, not only is that liquidity grab, that line right there on the 5-minute chart, a low on the 5-minute chart, it is the low of this hourly candle. And we have this fair value gap between this candle's high and this candle's low. Notice price is also displaced over this short-term high. So we have multiple reasons to buy now based on the hourly chart and on the lower time frame as well. So going back to the 5-minute chart, we can see that hourly fair value gap overlaid on top. Now we can look on the 1-minute chart for a possible entry model. We have our fair value gap. We've taken out a short-term high, at least we have on NASDAQ and the Dow. So we can look for our entry. Also, price continued up. We could have drawn our fib from low to high. We can see that we get a reaction from our discount levels and then price flies higher. We can also see that this 1-minute optimal trade entry on the 1-minute time frame, if we go to the 5-minute, we can see that we have a 5-minute order block created and then price hits that and flies. So again, this can be customized. Maybe you never want to go to the 1-minute. Maybe you want to go to the 2-minute or the 3-minute. You can kind of do it how you want to do it. If you want to be really, very strict and very, very mechanical, that's your choice. If you want that flexibility, if you want to say, oh, I missed it on the 1-minute, but hey, on the 5-minute, I can see we're coming into the order block after reacting off of this, after taking the sell side. The whole point is to really understand the logic of this and understanding how price and time work together. And from that, once that's clear to you, then you may decide that you are more open to being fluid with where and when you want to enter. As long as you're getting in at a discount, you're getting in at a good level, and you have targets, let's say above that you think price could still be reaching for, then that might be what you want to do when you have more experience and more confidence. Here's the next example. Here we have a lot of liquidity building up. We have this imbalance here before the market opens. Then at 9:30, the market shoots down. This is our liquidity grab on NASDAQ, and we're making a higher low on S&P. So this is our divergence. So step 2 is met. Now we want to look for an entry model. We go to the 1-minute. We can see that yet again, we have even more divergence again on the 1-minute. After that divergence on S&P, we have this order block on both of them created. We have this little high that got taken out. Maybe we're hypothetically going to buy that order block, and a beautiful reaction off of that order block here. It formed a little gap as well on NASDAQ, and we get this very nice move higher. So now you're at 10 a.m. and you're seeing this big displacement. So before that day, we can see this is the day before that setup appeared. So the day before this setup, we can see that we're trading into this discount area. We have this order block, this bullish order block. We've been kind of an uptrend. We've taken out internal lows. We have this imbalance. And so price has come in the day before and tapped into the order block here. And NASDAQ, it hasn't quite reached it yet, but still we're in this discount area. So what does the day look like after we get that set up? It looks like this. Again, we're not predicting that price is going to react off this order block and make a new high or come up all the way up here and fill this imbalance. We're just looking for a reasonable justification to why this is a buy setup that we might want to take. And for me, we can just see this as a reaction point where we could see some sort of move. And it doesn't look like you're getting a big move on the daily chart, but clearly something like this would be lovely on any day to get a clean run like this, a very tight risk to reward. And you have the basis of the higher time frame to say, hey, based on the higher time frame, we may see a bounce here. It wouldn't be unreasonable to expect a bounce. And then you overlay that with the lower time frame setup. Next example, you can see the market has opened. We have this liquidity grab above this high on NASDAQ. We have a very much a lower high on S&P. Sometimes it's very, very obvious. This doesn't come anywhere close to the high, whereas NASDAQ makes the higher high. And we go to our lower time frame. and we say, okay, I'm going to look for a setup. But what happens is price runs and never gives us our entry, never gives us the retest. And I just wanted to show you that some days are going to be like this, where you have the bias, you have the setup, but you just don't get triggered in, just like any other trading strategy or trade system. There's going to be ones where the train leaves the station without you, and that's just what happens. But I just want to point out one thing. This was the candle at 10 a.m. This is when that candle closed. So I just want to point out how you can be creative with this. Now, I'm not saying I would do this, set a market order right here at the 10 a.m. Candle close with the stop right here, targeting the sell side liquidity. Clearly it worked. In hindsight, we can say that. But how could you be creative to think to maybe do that? Or maybe you see a break of this low to enter, or a reclaim of the New York Stock Exchange open, or a break below this big bullish candle. Maybe you have some other mechanism for wanting to get in. I would never do that based on just this time frame alone. But if you do bring in the higher time frame, and you can see now on the 15-minute chart on S&P, we had this nice impulse, this displacement lower through a previous day's low, and now price has been correctively moving back before the market opened, and then at the market open spikes up into that gap where we have our divergence with NASDAQ. We get this wick close at 10 a.m. We know 10 a.m. is a likely time where we could see a turnaround. So, maybe there is a way to get in without kind of the entries that I've showed you before, where, that I typically use, which is just like limit at the fair value gap or limit at the order block. But maybe there's other ways that you can take advantage. So now we have gone over the two types. Now let's go over type number 3. Type number 3 is what I call the false start liquidity grab. You might say, well, what is a false start? If you haven't been following any of my other videos, I will explain what a false start is. False start, really quickly, it's an ICT. I don't think he calls it this, but you'll know what I mean when you see it. It's a strong looking candle or series of candles that entices participants into the market prematurely. Price will then undo that move by retracing over 100%, and this will engineer liquidity for the quote unquote real move in that same initial direction. Okay, so what does that mean in actual practicality? It's basically something like this. You can see this is kind of like the opposite of a Judas swing. Judas swing is the first move up, this sort of a false move that then traps everyone one way before kind of expanding the opposite way. This is kind of a different twist on that. At 9:30, the market suddenly expands at the open. And what I love about type 3 is what I love about the false start is just, I feel like I can really see the market psychology playing out very quickly on the chart. And it's great when you see it, because you see this sudden move, and what does that do? It gets a lot of people very excited. They see, this very big impulse candle or a few candles spiking up, and it just looks like it's going to be a day where price rallies and never comes back. And, so people buy anywhere in this price leg, and they put their stop below the low of the opening candle or whatever swing low is here, and they think they're going to, get a huge trend. And what ends up happening is step 2, we can see that price comes all the way back down and takes out that candle, that swing low. And this is where we will see our divergence. So you look at the 2 and you say, this is making a lower low, this is making a higher low. I think it's probably a false start based on the higher time frame as well. Maybe you bring that in and you look for your entry. Now, similarly, you might look for a lower time frame model on here, or on here, on either chart, you might look for the lower time frame model. And once again, you might target 10, 10:30, noon, whatever the case may be for our exit. First example of a type 3, before the market opens at 9:30, we have sell side liquidity level, which is not pictured. It's a old low, some sort of Asia low or something like that. Price took sell side liquidity on both. There's no divergence here. We get a consolidation, and then we get expansion up, and the market pauses for a bit, and then at the open we get another expansion higher. And so the market is feeling and looking very bullish at this point. So we look at the 1 minute time frame now, and we can see that we have these equal lows on S&P. And what do we know about equal lows? They're likely to get taken out. What does the market do? It comes all the way back down, takes those equal lows. Here we have our divergence. So we have our liquidity grab on S&P. We have our divergence on NASDAQ. And now we can even see it here. We can see the displacement starting to kick in. Also zooming out on the 15-minute chart, at that same point we took the equal lows out on the 1 minute is also a 15-minute fair value gap. And so now we have multiple timeframes working together. Now we go to the 1 minute chart and we can see that this order block has a nice bounce. This is a breaker as well that you could have used. But if you draw the fib from low to high, it doesn't quite hit the 62. So again, it's not going to always be the same every time. Another example of a false start. Here we can see that similarly, we have our market opens, it shoots down, creating a sudden move down. We've been moving down all day. So at the open, market moves down, everyone continues selling. What does it do? It comes all the way back up, takes the high here, takes the high here. We get our divergence here. Once again, also, yes, we can see that this can happen here in alignment with what I said about the 10 a.m. So in here, it's 10:05, just 5 minutes after. We know that this can be a turning point. We can know that this could be possibly a swing high. We overlay that with this being a possible type 3 liquidity run, that this was just a false start. Look what happens. Again, this is a very choppy one, but again, just to show you that they're not all going to be picture perfect all the time. And on this particular day, you can see that we were just in this big, massive daily consolidation. And so maybe when you pull up the daily chart and you see what kind of conditions we're in, maybe you don't want to trade that day. Next big point I want to make is that at times there's going to be SMT confusion. Here we have a pre-market liquidity grab with divergence. And we might say, okay, this is a type 1 buy setup, right? It has to be. But then you play it forward a little bit more, and you can see that after 9:30, after the market opens, we have also a potential type 2 sell setup. After 9:30, we have the liquidity grab on NASDAQ. We have the divergence on S&P. Now step 3, yep, I see a displacement right here to the downside on S&P. We've taken out the short-term lows. We have our gap. We've been in this downtrend. Previously, we've reacted off of this fair value gap. And, so that's what this is. It's a type 2 sell setup. But if you were to look at the higher time frame and you can see that actually that bearish displacement that I just showed you on the 5-minute chart occurred right here at this weekly bullish order block level. I've highlighted it in blue right here from the upper wick, from the high to the opening price. For several weeks, we've been making higher highs on the weekly with very nice closes. And it just shows that this is not really the ideal place to be looking for bearish displacement. And so that's why I mean by the confusion. So you had the type 2, type 1, but it's actually a type 1 and type 3 technically. I'm not saying this would have been a great trade because I don't think the displacement was that great to the upside here. But you can see we had our pre-market divergence and liquidity grab. And we also had type 3 because if we look at from the opening candle, we can see we get this sudden move up, price comes back down, takes out the low. We get our entry, price shoots up. This is just, on the 1 minute, you probably see it a little bit cleaner, but we get our divergence for type 3. That's what the green line is. So again, after the open, and then this could have been the entry here. So there was a trade here, but that's why I like using SMT as a confluence or as a confirmation. So here we have a type 1 sell setup shaping up here where we have our liquidity grab on S&P, our divergence on NASDAQ. We have our little displacement. We can see we have our fair value gap here. And then at the open, after the open, price taps in on NASDAQ into our gap and shoots straight down to our target. Great, we made 2R. But what else is apparent on this day? Well, can you see that after the open, we've taken out this low right here, and we're potentially making a higher low right here. And so this might actually be a type 2, where after the open price shoots down, takes the liquidity with the divergence, and maybe there's a setup in here. More on that just a minute. Maybe instead of a type 1 sell setup, it's actually a type 1 buy setup. And we can see that we have our liquidity grab on NASDAQ, our higher low on S&P, our displacement with our gap, and we might want to be a buyer here. And we can say, which is the better buy? Clearly, as I showed you before, NASDAQ took out this low, made a lower low. S&P respected this breaker and this 62 fib with this fair value gap here. Didn't make it down to this one, but it hit this one here. There's a volume imbalance there as well. And then it flew like a rocket ship. Meanwhile, NASDAQ also went up well, but it had another liquidity grab here. So that was that sell trade right here that I showed you, that possible type 1 sell that you could have gotten like 2R down here. But you got to keep your head on a swivel sometimes, because not only was that a type 1 buy and a type 1 sell, but it's also a type 2 buy setup. Whoa, this is probably a lot to handle, so you might want to rewatch this a couple times. But as I said, we have our liquidity grab on NASDAQ, our divergence on S&P, and we can look at our lower time frame now. And we can see on NASDAQ and both of them, we've taken out this high. We have our little displacement. We've taken out this short-term high here and here. We have our fair value gap inside, and we can have our fib. And depending on where you had your order, you could have been involved in this move. Looking at the daily chart, could it have helped you decide which way you want to go? I think so. We have our daily order block level, and this was the day before that setup looked like this, and the day after it looked like this. You can see this was the expansion up that we saw this setup here. So that's that. And again, which is the better buy? How else can you determine? This was another thing I wanted to share with you. This is another way. So it's not always the higher low or the lower low or which one grabbed liquidity or which one didn't. Here is another way. If you measure from the lowest low after midnight to the New York Stock Exchange opening price on a day where you might be looking to buy, and you see a big difference between the two, let me repeat. S&P made a 0.5% move off the low of the day between that time and New York Stock Exchange open price level. At the same time, NASDAQ was about half as strong off of the low of the day. If you're one that's always taking liquidity grabs and it doesn't work, this might be a reason why. If you were to incorporate something like this, maybe it could help with your decision making. It's not always going to play out perfectly, and sometimes it's not as drastic as this. Sometimes the numbers are similar, but I've noticed that when there's quite a big discrepancy between the two, this to me is the stronger one. S&P is the stronger one, and the one I'm more inclined to want to buy. Here we have another example. Which is the better buy? Here we have a lower low, we have the higher low. So is the one that's making a higher low the better one? Well, again, if we look here, we can see that NASDAQ has considerably more strength off the low of the day versus S&P. We can see that here they both would have played out, but NASDAQ had the stronger move, clearing buy-side liquidity, whereas S&P gave a little bounce, but it did not make a new high, so this gave a better move. So final thoughts on this. You might want to consider a mechanical approach, at least in the beginning, or if you're not as experienced, using maybe OTE levels. Gives you a line in the sand. I'm buying at this level, I'm selling at this level, I'm taking partials at this level. So it's a good way to be objective. I still do that sometimes. If I'm not really sure, sometimes I just default to that. It can be good to take the decision making out of it. If price has a big move overnight between 2 and 5 a.m., let's say, consider avoiding trading the opening range. That's our AM session, particularly if you're looking for continuation. So if you're looking for a reversal based on something you're seeing on the higher time frame, I think it's okay. If price has a huge run higher, let's say overnight, and then you see a setup that would be a reversal to that move, I would consider taking that. I'm not saying you should do that, but that's something I might consider doing. But if I'm looking for a continuation, if I'm still bullish after that huge run up, you might want to sit it out in the AM session because price is likely to, potentially consolidate. And then, you might get that continuation in the afternoon session instead. And then clearly it takes time to train your eyes for this. It takes time to incorporate higher time frame. You might have other things you want to bring into it, other confluences. And so it just takes practice. It takes time. I do think it's good to recap each day in your own journal, in your own notebook, see what trades could have been had, see what types you see, what days of the week do they appear on, so on and so forth. And that's it. Thanks for watching. I hope you enjoyed this presentation. I'm sorry if it was a little long. Please leave a like. Please subscribe. Leave a comment. Let me know what you think. And that's it for this video. We'll be back again soon.